Look, recently the market hasn't been doing too well. Just last week we saw a drop of over 3% on the TSX index. Honestly, it doesn't even bother me anymore. The market's been up and down since like mid-2022. I'm looking to play the long game. Investing in the market shouldn't be a short-term play. That's why a majority of my portfolio is invested in indexes. You know, the TSX index or the S&P 500. Historically growing at 9 or 10% rate despite having minor setbacks. But that being said, I'm still always looking for stocks that can consistently beat the market. And really research on why they can beat the market in the long run. Because if you've got a history of beating a 10% return annually, your company is doing pretty well historically, and I want in, and you should definitely consider getting in too. Let's start off this list with Waste Connections. That's right, the dumpsters business. Quite boring, but historically speaking, one of the most underrated yet resilient industries during an economic downturn. Just think about it, humans are always going to produce waste. Whether you use your own bags to shop for groceries, or believe in recycling, which by the way, Waste Connection also manages, society always needs a landfill solution. So Waste Connections is the second largest player in the waste industry in Canada, only behind Waste Management, which is a US company. Despite consistently outperforming the Canadian market throughout history, and even beating the TSX index returns year to date, analysts are still listing the stock as a buy. Now why is that? Let's dig into the financials. First of all, the PE ratio or the price to earnings ratio is about 41, which is a little bit high. The average Canadian market PE ratio is about 17. You usually only see PE ratios on the higher side for tech stocks that have a lot of investor interest. But this is a dumpsters company. Does that mean that Waste Connections is overvalued? Not quite. The PE ratio is only one part of the equation, not all. Let's look at the financial reports. It takes a while to fully understand a bunch of numbers on a financial statement. Unfortunately, you kind of have to because it's very important information to analyze the company. Or subscribe to my channel where I just summarize everything for you. I make financial tips for Canadians in my long form content and financial comedy in my shorts. Alright, let's continue. Let's look at the second quarter results. I don't think they released the third quarter yet. You have 3 months reported revenue of just over $2 billion. Intercompany eliminations is a term you'll hear from time to time, but it's really not that important in this moment. And you have EBITDA of about $628 million. Now remember, the numbers showing here are in thousands. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Very common term on balance sheets. So you're looking at an EBITDA margin of about 30%, which is quite healthy. Looking at earnings per share, yeah, there are some bad periods in 2011, but even during COVID, the company managed to stay profitable. And you can really see that the earnings per share is showing sustained growth. Gotta admit, I'm not invested in the waste industry just yet, but seeing a company like Waste Connections doing so well over the years, and even beating the market, maybe I should consider investing in this sector. The next stock, let's talk about Constellation Software. Constellation Software, if you don't know, is a leading provider of software and services to a select group of public and private sector markets. They acquire, manage, and build industry-specific software businesses which provide specialized mission-critical software solutions that addresses the particular needs of our customers or their customers. You know what I mean. Maybe you need a summary. So to summarize, they're basically a holding company, that's how I view them, for a bunch of smaller software companies they acquire throughout the years. So essentially, they're a company that focuses on creating softwares for particular industries instead of, softwares that different industries can use. So they're pretty specialized, but in a variety of industries because they acquire so many companies. So I guess in reality, you can consider Constellation Software a venture capital company. So let's dig into the financials to see why their stock is so successful. I mean, immediately you can see that the PE ratio is at about 90, much higher than average, even higher than the waste company we talked about like a minute ago. But then again, this is a tech company, so it's not all that uncommon. What we want to look for are the income statements. Revenue, gross profit. You can see that in the past couple years, the revenue grew by basically about 2 times, and in the past 4 years, the EBITDA grew by about 75%. I would say that's pretty solid. Financially, they're also pretty solid with a strong cash flow. And if we look at earnings per share for the past 5 years, it's showing signs of increases year over year. The only problem going forward is that the vertical software industry seems to have more competition in the recent years. Vertical softwares are essentially softwares that target specific industries, which is what Constellation Software is. That being said, historically speaking, the leadership at Constellation Software seems to know what they're doing, and it's not like there weren't any competition in the past. fast. So I really don't see the increased competition being a major roadblock for the stock performance. Unless you can buy fractional shares, paying over $2,800 for a share seems kind of out of reach for most people. So instead, you can still invest in Constellation Software by buying the ETF XIT, which has over 25% of its holdings in Constellation Software. The last Canadian stock that is consistently beating the market is Couche-Tard, one of the biggest convenience store brands around the world. They've acquired some major players throughout history, most notably Circle K. And I actually found this stat quite interesting. Half of North American high school students shop at convenience stores weekly, which makes sense. You know, you walk home and you stop by a convenience store to get some snacks. Plus, in Asia, convenience stores are like everywhere. There's practically 2 at like every block, like in Japan, Korea, or Taiwan. Why is that? Because you can do everything there, from grabbing a snack to getting lunch or dinner or even picking up packages. What I'm trying to say is, the convenience store market has huge rooms to grow. And what we're seeing here in North America, not even close to its full market potential. And Couche-Tard's portfolio isn't just convenience stores. They're also in the gas station business as well. Of course, in North America, you have a convenience store and then you have a gas station that's partnered with it. So enough with that, let's analyze the stock first. The PE ratio is at 17, which is about average for the Canadian market, so there's a less likelihood that investors are overvaluing the stock. Doesn't eliminate it, but certainly safer than PE ratio in the 90s, for example. I like the fact that they summarized everything into this PowerPoint version for September 2023. This timeline talks about the history of the company and its acquisitions. The biggest one comes from acquiring Circle K. Alright, let's talk about revenue and profit mix. You have fuel taking up almost 75% of the revenue but only half the profit, whereas merchandise takes up only a quarter of the revenue but half the profit. Honestly, that makes sense. Being a convenience store, you have the advantage of generating more profit on your products than, say, grocery stores. And they tell you how resilient they are to downturns. Looks good, I mean, the sales continue to grow despite economic uncertainties. And I like how they show themselves off. Remarkable cash generation capacity. But the numbers look good, consistent EBITDA growth year after year. And what I like about this company is that it's investing its profits back into its own business. While they claim to be deploying 35 to 40% EBITDA into purchasing infrastructure, and I actually like this page, more balanced growth going forward. Because I said before, there's so much potential in the convenience store market that's not open yet in the North American market. And they have some very strong competitive advantages over their main competitors like grocery stores or retailers. If they can somehow uncover that in the North American market, then there's no need to keep acquiring. And just take a look at earnings per share throughout history. Pretty impressive growth. So it's really no secret how this stock can consistently outperform the Canadian market. Alright, that's it for today, but those are the 3 Canadian stocks that consistently beat the market. And I will highly recommend considering them based on the histories. Alright, remember to like and subscribe to my channel if you haven't done so already. Take care and I'll see you next time.